Hello, good evening, everyone, and a very warm welcome to the fourth edition of JH's Knowledge Setu. It is pleasure to have you all of you with us today for the discussion on the topic that has become increasingly important as a wealth, investments, and business become increasingly global. Uh, 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 India's relationship with its global diaspora is significant. India received approximately US dollar 135 billion in remittance in financial year 2024-25, while NRI deposits with Indian banks stood at approximately US dollar 165 billion as of March 2026. With over 35 million people of Indian origin living outside India, the economic relationship between India and its diaspora extend far beyond the remittance. NRI continue to have significant economic connection with India through property ownership, investments, bank deposits, businesses, capital market investments, and other financial assets. At the same time, this raises several important questions. How does this tax residency determine an NRI's tax liability? How are Indian income investments and property taxed? How do cross-border tax treaties and wealth transfer impact individuals and families? And what should they consider while planning their cross-border wealth? While India does not publish any single consolidated figure for the total tax paid by the NRIs, the tax contribution is spread across multiple areas, including tax on Indian source of income, capital gains, rental incomes, business income, and the property transaction. So today's discussion is about understanding the various ways in which NRIs remain economically connected with India and how taxation applies to their income, investments, assets, and wealth across borders. To take us through these important subjects, we have three distinguished speakers today, presenters with us. Our first presenter is Ms. Gitika Ghata. She's a CA. Gitika is a chartered accountant specializing in financial planning and analysis, FNPA, corporate finance, digital transformation, financial governance. As a financial consultant and ERP advisor, she helps organizations improve financial performance through strategic planning, automation, and process optimization. With over 7 years of experience, Gitika has built expertise across recruitment, IT, pharma, healthcare, and construction industries. She has led budgeting, forecasting, cash flow management, financial reporting, audits, ERP implementation, and finance transformation initiatives. Passionate about finance, innovation, and operational excellence, Gitika is committed to drive sustainable business growth through technology-enabled financial leadership. Our second presenter is Ms. Monica Desai. She's a director with over 15 years of expertise. CA Monica Desai has established herself as a trusted advisor in income tax, international taxation, NRI advisory, and the cross-border tax planning. As an associate director at JH's Baroda branch, she provides strategic tax solutions to individuals, NRIs, expatriates, HNIs, and corporate clients. Throughout her career, Monica has developed deep expertise in DTAA planning, foreign income taxation, FEMA regulations, tax assessments, and international tax structuring. Her practical approach enables clients to confidently navigate complex cross-border tax, regulatory, challenges. Driven by the commitment to excellence, Monica continues to simplify complex tax matters through strategic advisory, helping clients achieve compliance, optimize tax outcomes, and make informed financial decisions. And our third presenter is Mr. Huzaifa Mala. Mr. Huzaifa Mala is a seasoned chartered accountant with over 15 years of experience across taxation, accounting, and advisory services. He specializes in income tax, GST, tax compliances, and holds extensive expertise in assessment, appeals, and litigation matters. He's currently a director at JHS Consulting whereas he leads tax advisory and outsourcing verticals, managing large-scale operations, including global clients across industries. His work spans domestic international markets, including the USA, UK, Canada, and GCC region. Recognized for his strong leadership and client-centric approach, he has held key positions with ICAI committees and founded the Baikala CP Study Circle. He is also a passionate educator, serving as a lecturer at reputed colleges and mentoring aspiring professionals while contributing to the field of taxation and compliance. We are pleased to have you all three of them here with us today, and I'm sure their insights will provide valuable perspective on the various tax, regulatory, and practical considerations relating to the cross-border wealth and NRI taxation. So without further delay, let us begin with. Our first presenter is Ms. Geetika Kata. Geetika, over to you. Thank you.
Yeah. Thank you, Deepika. So good evening, everyone. My name is Geetika, and I'm here to discuss on NRI taxation. So I've seen exactly how brilliant financial strategies can succeed or fail based on the tax planning. So that is why we are all here today. We are breaking down the absolute bedrock of Indian taxation. So you can walk away with clear, actionable clarity on cross-border tax compliance. Whether you are a global professional, a corporate planner, or someone managing the cross-border finances, understanding these rules is crucial because your residential status dictates exactly how much your global income India can tax. So let's get right into it. So I request someone to present the PPT. Yeah. So let's start with the basic. In the realm of Indian taxation, your citizenship doesn't decide your tax liability, but your residential status does. And this status is not permanent. It is determined afresh for every single year, strictly based on the number of days you are physically spent in India. So next slide. So under the income tax, an individual falls into the below three categories. That is ROR, resident and ordinary resident, RNOR, resident but not ordinary resident, and NR, not non-resident. So to figure out which basket we fall, we just follow simply two steps. That is step 1, which is a basic condition. This determines whether you are a resident or non-resident. And then we have one more step, that is additional conditions. Once you are satisfied, once you are qualified as resident, the additional conditions determine whether you are ROR or RNOR. That is resident ordinary or resident not ordinary resident. So we have transitioned through this legislative updates from Income Tax Act 1961 to Income Tax 2025, but these core tests and frameworks remain identical under both the regions. The logic has not changed in the new region. Next slide. So now let's clearly understand who is a resident, who is resident, not ordinary resident, and non-resident. So now let's break down the test. The first basic condition is the 182-day rule. So to be qualified as a resident, you only need to meet any of these two conditions. The first condition is 182-day rule. If you are in India for 182 days or more during the relevant tax year, say for example, if a person or an SSC has stayed for 180 days in a current year, he is qualified as a resident because he satisfied one of the condition. And the second basic condition is the 60-day rule. Here it is a dual trigger condition. The condition is that you must be in India for 60 days or more during the relevant tax year. And here it is an and condition, which means the individual or SSC has to satisfy both the conditions. The SSC has to stay cumulative of 365 days or more during the 4 preceding years. So let me break down with an example. So if the individual has stayed for 75 days in a year, he didn't satisfy the condition 182-day rule. But in the second rule, yes, he is satisfied because he stayed for more than 60-day rule. And yet, he has to satisfy one more condition in the second rule, that is he has to stay for 365 days or more. So in the given example, if an individual stayed for 75 days and 410 days in the relevant preceding 4 years, yes, he is qualified as a resident. So if you don't meet either of these conditions, like you have not stayed for 182 days or more, or even you have not stayed for 60 days or more in the financial year, then straight away you are called as non-resident. Like the example, like you have stayed for less than 50 days or less than 60 days, and you have not stayed 365 days in the last 4 years, you are called as non-resident. Next slide. Now comes the additional conditions. So once if a person is qualified as resident, then we look at the additional conditions to check if he is a ROR or RNOR, that is ordinary resident or not ordinary resident. To be called as ordinary resident, then individual has to satisfy both the condition. What are those conditions? The condition is that he has to be at least resident for 2 years out of the 10 preceding tax years, or he must be physically present in India 730 days or more during the 7 preceding tax years. If a person satisfies both the conditions, then he is called as resident ordinary resident. If he is not satisfied any one of the condition, then he is called as resident but not ordinary resident. And here there are few exceptions to the 60-day rule, which we discussed in the previous slide, that is the basic condition. As a tax professionals, we must watch out for the exceptions. So there are certain individuals or certain persons, they have few exemptions for this 60-day rule. So let's look into it. If an Indian citizen who is leaving India for the employment abroad, or an Indian citizen who is leaving India as a crew member of an Indian ship, here, in the basic condition, the 60-day rule is replaced with 182 days. In these two scenarios, the individual has to present 182 days or more, and he must be 365 days in the preceding 4 years to be qualified as resident. Once he is resident, then we'll check out whether if he is ordinary or not ordinary. And Indian citizens or persons of Indian origin whose income is up to 15 lakhs. Even for them, it is 182 days plus 365 days in the preceding 4 years. But the Indian citizens or person of Indian origins who is visiting India with income is more than 15 lakhs, then this 60-day rule is replaced with 120 days plus 365 days. So these are the few exceptions to the basic conditions when we are deciding whether he is a resident or non-resident. Instead of 60 days in the second rule, we will check with 182 days for the first 3 scenarios. And we'll check if the income is more than 15 lakhs, it should be 120 days. Next slide. So let's have some practical examples. We will understand in each example whether it is resident or ordinary or NOR or NR. So to make this completely clear, let's have this practical example. So example 1, suppose a person stayed in India for 200 days and he is resident in 3 of the last 10 years. And he has stayed for at least during the last 7 years, he has stayed for 850 days. So now let's check the basic condition, that is he stayed for more than 182 days. Yes, he is a resident. Now let's check whether he is ordinary or not ordinary. So the resident is stayed for three of the last 10 years. So he satisfied the additional condition 1, and he has stayed for more than 730 days. So he has satisfied the second condition of additional condition. Since he satisfied both the condition, he is resident and ordinary resident. Let's look at the example 2, where an individual stayed in the current year for 190 days and he is resident in only one of the last 10 years, and his stay for the last 7 years is 500 days. So he satisfied the first condition, that is he stayed for more than 182 days. So he is a resident. Let's check if he is ordinary or not ordinary. So he is resident in only one of the last 10 years. So he didn't satisfy the first condition of additional condition. And he stayed in the India for 500 days. So he didn't even satisfy the second condition of additional condition. So he is a resident, but he is not ordinary resident in this scenario. Let's look at the example 3, where an individual stayed during the current year for 70 days and he stayed for 250 days in the last 4 years. So the basic condition itself is not satisfied because he didn't stay for 182 days. And the second condition is he stayed for 60 days, more than 60 days, but he didn't stay more than 360 days for the last 4 years. So neither of the basic conditions is satisfied. So he's not even a resident, he's called as non-resident. So now let's look at some taxability comparison. The next slide. So now why it matters, why we need to know the person is a resident or non-resident or RNOR. Why all this matters? Because of this matrix on your screen. So let's look at how income is taxed based on the individual status. So income received in India or accrued in India is universally taxable. It doesn't matter whether you are a resident or resident, not ordinary resident or non-resident. So income accrued or erased in India is taxable for all the three types of SSCs. The foreign business, which is controlled from India, here where the split happens, it is taxable only for resident ordinary residents and resident not ordinary resident. It is completely not taxable for non-residents. And other foreign income like rent from a property which is based outside India and any dividends which we have earned from the shares outside India, it's only taxable for resident ordinary resident. It is not taxable for RNOR and non-residents. It is completely out of the tax purview. In short, resident ordinary resident pays tax on global income. So whether he receives tax in India or outside India, he has to pay the tax. And non-resident or RNOR only pays tax on Indian sourced income. Next slide. So now let's see how NRIs and how the specific heads of income are treated for the non-residents. Say the salary head, if the salary is received in India and the services are rendered in India, regardless of paycheck, whether it is received in India or it is received outside the Indian bank account, if the services are rendered in India, the salary is taxable in India for the non-resident. But the salary for employment if the employment is done outside the India, then it remains non-taxable unless if there is a deeming provision like income is deemed to accrue or arise in India. Otherwise, it is not taxable if the salary employment is done outside the India for non-residents. Let's look at income from house property. Rent from house property, if it is situated, house property is situated in India, it is fully taxable for an NRI. Even they are eligible for the standard 30% deduction and the interest deductions, just like a resident we have. If he has taken any loan, he even can claim the interest deduction and the standard deduction. But if he has the rental income from the foreign property, if he has some house property outside India and if he is receiving rent outside India, it is completely not taxable for an NRI in India. Next slide. Interest income. So here comes the common area of confusion because the NRIs hold different types of accounts like NROs, NRE and FCNR. So NRO is non-resident ordinary account and NRE is non-resident external account. FCNR means foreign currency non-residence bank account. So if any interest is earned by the NRI in the NRO account, it is completely taxable and it is subject to the TDS. And but we can claim relief subject to the DTAA conditions. But if interest income is earned in the NRE account, it is exempt under section 10(4) if the individual is qualified as non-resident. The same way if the interest is earned on FCNR deposits and all, it is completely exempt for the non-resident. But if the interest earned on fixed deposits or bonds or debentures in India, the non-residents have to pay the tax for that income in India. And it is also subject to the TDS provisions and also DTAA provisions. Next slide. Next come the dividend income. If the non-resident NRI is earning the dividend from Indian companies, it is taxable. It is taxable in India and TDS is applicable on that. If he is receiving dividend from foreign companies, it is not taxable in India. Next slide. Then income from other sources. If the non-resident is earning these incomes in India, like the family pension, or if he received any gifts in India, and if he has won any income from the lottery, crossword, or online gaming winnings and all, and if he received any compensation or enhanced compensation for any property taken by the government and all, and any other income if it is accrued or arising in India, all these incomes are taxable for the NRIs in India and they are subject to the TDS provisions. Next. So now let's look at the income tax slabs. So here, as per the new regime, the basic exemption limit for NRIs is the 4 lakhs. And the highest slab at 30% hits if the income is about 24 lakhs for non-resident in India. And the crucial point for NRIs is that there is no tax rebate under Section 87A. It is not applicable to the NRIs. And they are subject to the health and education cess, and they are subject to the surcharge if they are having income more than the surcharge limits. Say like up to 50 lakhs, the surcharge is nil. And if it is crossing 50 to 1 crore, it is 10%. And 1 crore to 2 crore, it is 15%. Above 2 crore, it is 25%. And the marginal relief may apply based on the surcharge. So with this, I hand over to the Monica. She will take up on the DTAA and other regulations. Over to you.
Thank you. Thank you so much, Gitika, for sharing those valuable insight and setting the context for the discussion. Now, we'll continue with the next part of the session. So over to you, Monica.
Good evening, everyone. And thank you, Deepika, for the introductions. And thank you all the participations for joining. Please share on next slide, please. My point is, my topic here is DTAA and foreign tax credit, how it is useful to NRI with the Income Tax Act or our domestic law. Next. Next, please. Why DTAA matter? So in DTAA, there is domestic law sets the starting point. Every country set what is the taxable income. Like DTAA settles the tax claim. DTAA determines who gets the first right to tax and how double taxation gets relieved when both the country have a right to tax or have a claim. Second. Next. There are few treaties which are most important for NRIs. This is the first one is the Article 4 residence. This is a tiebreaker because this article comes into the picture when both the person is resident in different countries under their domestic law. Then there is it is fixed on the basis of like permanent home, center of vital interest, habitual adopt, nationality or mutual agreement. The Article 6 is related to immovable property. Income from immovable property is taxable in the country where the property is situated. This is nearly a universal rule across the treaties and generally does not give NRI any relief. India retains the full taxing right on the Indian real estate income regardless of the treaty. Another is Article 10 dividend and Article 11 interest. This is more or less the same. Treaties limit the rate around 10 to 15% instead of India's domestic rate. In case of dividend, it's a flat 20% plus surcharge says. And in case of interest, TDS is deducted on NRO interest at a higher rate and then it's taxable according to their threshold. There is no question here to cover NRE or FCNR because NRE and FCNR interest is fully exempt. Next. Next is the capital gain. Capital gain varies significantly by treaty and assessed type. Immovable property gains are almost always taxable in the source country, but gains on shares, mutual funds can differ. There are two types. One type of treaties allow a resident country to tax and others few are allowed to source country, like including UK and USA. Now, large UK and USA reserves the right to tax gains on Indian assets on India, but countries like Mauritius, Singapore, in that cases, it is on resident basis. We just take one classical example on it. In original Indian-Mauritius Treaty in 2000, the pre-2017 1982. Capital gain arising from the sale of shares in the Indian company were taxable exclusively in the residence country, investors country of residence. It means in Mauritius, and India has a no right to tax on it. But to prevent this treaty shopping, in 2016 protocol and grandfathering apply. In that cases, shares acquired after 17, now India has a right to tax on it. But in case of the shares acquired before April 17, in that case still grandfathering apply and India has not right to tax. One IT80 rules that in Mumbai IT80 that an NRI from Singapore is not liable to pay tax in India on rupees 1.35 crore short-term capital gains from mutual fund redemption, because the verdict of the judgment is like a mutual fund units is not the share, so it's covered under the residual provisions, and the tax rights is all with only a resident source basis. Next is employment income. In employment generally, employee is taxed when a person works and when there is an employment exercise. But in a short stay exemptions, commonly a 183-day test, under which income is taxable only in the residence country. The test is like you are there 183 days or less in the fiscal year, but your salary is paid by the employer who is not a resident of that other country, and the salary cost is not charged to a or not linked to any permanent establishment or branches the employer has in that country. And that case is the tax right is with the residence country. The situation is arises in case of short-term business traveler or deputation, so they are not taxed twice for a brief work trip. The Article 23 regarding elimination of the double taxation. India is generally follow a credit method. In this, there are 2 points. One is an ordinary resident. In case of an ordinary resident, global income is taxable in India. In that case, resident take the benefits of DTAA on the foreign income and tax paid on their foreign income in their resident country. In case of NRI, if they pay tax in India on Indian income, they can take the benefits of foreign tax credit according to the domestic laws of the resident country. Next. Next is, when can treaty benefits be claimed? Treaty benefits are not automatic. They require clarify the resident country. Second is, the income falls under a treaty article that provides a rate or exemptions more beneficial than domestic law. And in that case, the documents required to claim TRC and the Form 10F or Form 41 in the new rules, a new act has to be filed. What is TRC? So no TRC, no treaty benefits, regardless of actual residency fact, issued by the tax authority of the country of resident, example, UAE Ministry of Finance, HMRC for UK, IRS Form 6166 for USA, must generally be renewed annually since it certifies residency for a specific period. Next. Now, why FTC is needed? What is FTC? Foreign tax credit only becomes relevant when a person is taxed as a resident, means ordinary resident in India, and the person has the foreign income subject to pay tax abroad. So in that case, global income is taxable in India. This is generally when a returning NRI or someone who spent through enough days in India to flip residency mid-career. Next. What is the eligibility timing? So it can be claimed if India has a DTAA. If India does not have a DTAA, then income should be similar to income taxable in India. FTC is allowed in the year the corresponding income is offered or assessed to tax in India and is available against tax surcharge and sales. FT is not available on the interest, fee, or any penalty paid on foreign taxes, and is also not available in case of any disputes. FTC is allowed even against tax payable under MAT. Next. How we compute the FTC. The credit of foreign tax is aggregate of amount computed separately for each source of income arising from a particular country. Each country wise, we have to calculate tax paid. Also, we have to consider tax paid each source basis. The credit is the lower of the tax payable under the Act on such income and the foreign tax paid on such income. If there is some excess, then it should be ignored. Foreign tax must have actually been paid or deducted. It's not merely accrued. 67, Form 67 must be filed correctly on time. Next, please. Filing the Form 67. How and when to file? File electronically on the Indian Income Tax Portal. It is advisable to file before the return, though Act allow to file it before the assessment year. But to avoid such scrutiny or disallowances, it's advisable to file before the return. Now in the new Act, Form 44, under the new Income Tax Act, 67 is become a Form 44. In that, one new addition is there. It is mandatory for the CA verification will be required when the foreign tax paid exceed 1 lakh. Currently, self-certification suffixed. Next. ITR, now we move on to different RTR disclosures in case of an ordinary resident taxpayer. It is not at all applicable if the status is non-resident. Schedule FSI, foreign source income. What to report? Every item income that has a foreign source country-wise, income head-wise, along with the foreign tax paid on each item. Report gross foreign income along with the tax paid detailed. This links to Schedule TR. Reporting is per country, per income head. Schedule TR, tax relief. This is where the DTAA relief and FTC claim is actually summarized. It's a breeze between a Schedule FSI and the final tax payable. The FTC figure here must match what was declared in Form 67. Next. In Schedule FA, what must be reported? Foreign bank accounts, foreign equity debt holding, foreign retirement accounts, any beneficial interest in foreign entity and more. Reported on a calendar year basis. Please note that we have to report it on calendar year basis, not the Indian financial year. For AY 26-27, then the calendar year runs from January 25 to December 25 in respect of the foreign assets or accounts. Reporting note, every account and holding must be disclosed. Even if there is no taxable income from it in the relevant year, non-disclosure risk attached to the assets, not the income. In that case, if you are not disclosing it, you can invite the scrutiny or assessment. Next. There are the different tax and penalty for non-disclosures under the Black Money Act. 30% tax rate undisclosed foreign income and the value of undeclared foreign assets are taxed at the rate of flat 30%. Three times penalty amount or 10 lakhs non-filing penalty, failing to disclose the foreign assets income or filing inaccurate particulars attracts a separate penalty of rupees 10 lakhs per instance. Next. In the Union Budget 2026, Foreign Assets of a Small Taxpayer Disclosure Scheme 2026 is announced. A one-time window. A one-time 6 months regularization window introduced in the Union Budget 26. It allows individual, example for NRI students, professional, to declare previously unreported overseas assets and income without facing severe prosecution under the Black Money Act. Next. Disclosure Scheme 26 eligibility. There are two categories here. One category is undisclosed foreign income and assets. It is applicable to whom? Individual with overseas income or assets that were never offered to tax or declare in India. Threshold limit. aggregate value of the undisclosed assets or income must not exceed 1 crore as of 31st March 26. Unreported assets from the taxed income in the category B. Individuals who fully disclose their overseas income and pay due taxes but fail to report the corresponding foreign assets in Schedule FA of the IDR. Threshold limit. Total value of the unreported foreign assets must not exceed rupees 5 crore as of 31st March 2026. Next. The main key takeaways from the presentation, DTAA foreign tax credit for NRIs. First, treaty benefits are not automatic. Always secure a TRC, file Form 10F before relying on treaty rate. Second is FTC available, but Form 67 must be filed correctly and on time. Schedule FSR, TR, FA must tie together. Mismatch between them are single biggest trigger for tax notices. The FASTIES 2026 window is one-time opportunity. Check the category A or B threshold well before the deadline. Thank you. And if you have any questions, then you can just post it. Thank you.
Thank you. Thank you, Monica, for those valuable insights. As we continue our discussion, now I would like to invite Mr. Huzaifa Mala to take us through the next part of the session. Mr. Mala, over to you.
Thank you so much, Deepika. Thanking Team JHS also before, and Geetika and Monica for setting the context for me to continue hearing forward. So continuing forward, with respect to what provisions specifically my colleagues have discussed, one important thing what we need to draw attention to whenever you take care of any kind of international taxation or handling clients or any case with related to NRIs, the important thing is that the first base of all taxation is the income tax domestic taxation itself. Unless and until your domestic provisions are not very clear, till that time there is no possibility that rightly you will be able to go on with international taxations or NRI cases. So first thing what we need to ensure is that all your relevant domestic provisions, whatever we understand, that is very clear in our mind first. Then those provisions have certain specific carve-outs, certain specific provisions which are specifically related to NRIs. That right away, again, the DTAA laws together is something what we basically ensure that right structuring of international taxation or NRI consultancies we are able to provide. So now, with regards to what my predecessor colleagues have discussed, let us try to take some examples, practical life examples and case studies, and understand how those principles, what we have discussed, we can apply. So one of the most important and like almost as a percentage, more than sometimes 50% weightage, where a lot of clients who are basically NRIs and based out of India, many times it happens that they have some or the other property which is here in India, which they are wanting to sell. So when they are wanting to sell that property, certainly you understand that capital gain provisions would apply. So first, can we go slide ahead on capital gains property? Okay, so let us take an example. Say we have Deepika with us. Say Deepika is basically a NRI. She stays in UAE, and she has a property here in India. Say for example, this property Deepika had purchased for 80 lakh rupees in 15/16, and currently she is wanting to sell that property. And the current price what she gets for this property is typically 1.6 CR. Now, one very important thing what would happen is that whenever there is a transaction with regards to resident, your regular 194 IA provisions of 1% TDS applies, correct? But what we need to understand here, that whenever you deal with any NRI taxation and whenever TDS pertaining to NRIs is concerned, there is only one old section 195 that applies, and the similar relevant provisions of the Income Tax Act 2025. So what would happen under this situation is, let us go to next slide, please. We try to do a little bit of computation of capital gains, and we try to understand how the taxation of this NRI client would personally go. So the property we are selling today at 1.6, this we had bought at 80 lakh rupees. Now in the regular provisions of capital gains, if the property was purchased before 23rd of July 2024, we had that grandfathering proviso, right? Where you could take that benefit of indexation and you could pay tax at 20%. And also alternatively, you have another option where flat, whatever capital gains of this 80 lakh rupees, you can directly pay tax at 12.5%. When you come to NRI taxation, the grandfathering proviso is not applicable or not available to them. So what is available to them here now is only one single regime, and that is pay tax at 12.5%. Now in this example, the capital gains or the income of this particular assessee, Deepika, is exceeding 50 lakh rupees. So when you calculate tax liability, considering surcharge cess, the tax liability happens to come to 11 lakh 44,000 rupees. Now the most pertinent point to be noted here is that whenever you are dealing with section 195, the TDS to be deducted by the buyer on this NRI seller will always be at this particular rate, but always on the gross consideration of sale. So he would deduct TDS always on 1.6 and not on the net capital gains tax. So what situation would happen here is that actually when you compute, your tax liability is 11 lakh 44, but this buyer is required to deduct tax on the gross amount at the same rate, thereby the total tax TDS amount deducted would be 22.88 lakhs. So what would happen in this situation is that an additional tax of 11.44 lakhs rupees would get deducted. This is first scenario. Second scenario, if this individual does not have a PAN and or he doesn't provide the PAN, then do we understand that 206 AA 20% TDS rate would apply? And we understand that the TDS deduction would be much higher again, and in spite of the very fact that the tax liability is actually less. So this is the problem statement what we are creating here. Now, certainly what can happen is that you can always file your return and you can always claim the additional amount of TDS again back as a refund. But then how to circumvent this and what is a better way of approaching this kind of issues? Let us try and understand and go to the next slide, please. Okay, so the problem what we saw here is that under section 195, the full amount of TDS was required to be deducted at the full amount of consideration, 22.88 lakhs, as compared to only the tax liability part of 80 lakh rupees. So in this case, what actually should be done is you need to do a little bit of pre-planning with the client. What this NRI client should do, that first, before getting into any kind of property transactions, he should consult his chartered accountants, team JHS preferably, and based on that, what would happen is that he would get an assistance where we can help him in getting a lower TDS or a nil TDS certificate as applicable. What are the important conditions here for getting a lower TDS certificate? Basic documentation, so whatever is required will always be forming part of the application that would be made. Importantly, he has to keep in mind that because sale agreement would not have been met at this juncture, this is before pre-agreement, he will need to make a MOU which would state the important conditions of what is the agreement of sale likely to look like. So whatever, like Deepika can mention in that MOU that the property was purchased on in 2015-16. Currently the value is 1.6. Whatever is the payment plan, intention that this MOU is being properly drafted currently, with the intent of getting a lower TDS certificate first, post which the other compliances and the registration of the property would be made. And this kind of an MOU properly drafted, notarized, can be submitted along with the application before the TDS authorities. On an average, at least 3 to 4 weeks of pre-planning is required. That is what we would suggest from a practical experience scenario. Because many times drafting these documents, getting it signed, making an application to the TDS officer, he getting it verified at his place, some queries coming in, getting approvals from additional, and then that lower TDS or nil TDS certificate coming in, it becomes a time consuming process. So that pre-planning is something what is very important in this case. Another important point what needs to be noted here is that the party, the NRI party should not accept any high amount of on account payments before getting into this transaction. So usually what happens is that, say example, in one of our clients it had happened that the transaction value, the client had almost taken 50% of the transaction value before actually getting into this MOU. And then he came to us, took the check, got the payment, deal done as a security deposit, and then they came. So what happens is that the effective rate of TDS what they should get, that they will not get, and the amount of TDS computation totally varies. And the rate what you're preferably wanting to get from a lower TDS or a nil certificate, that is something what the department will not allow you. So that is something what we need to take care of first initially. Then the low tax rate of 12.5% we have deducted. One another very important point that comes in is that once this gentleman sells the property or Deepika sells this property, then probably because she's staying in UAE, she would want to take that money back to UAE for her use in UAE. In that case, there are FEMA related compliances. So what normally she can do is that up to $1 million per year is the limit which she is allowed to repatriate back to her residence country, just on the basis of filing of Form 15CA, Form 15CB, of 145, 146 currently, and on the basis of that, the money can be repatriated. But then, if higher amounts is required to be repatriated, then you require specific prior approvals under the FEMA. In that case, what you can do is you can do again little bit of tax planning here, wherein you can pre-plan the things of pre-plan the transactions in a way that, if possible, you try and transfer the amounts, a part payment at least of 1 million before the year of March itself, and the balance amount in the next coming financial year. So that is some kind of things what is possible and what can be planned out. Further, one genuine practical difficulty what people used to face is that, specifically from the buyer's perspective, when they were required to deduct TDS, they were required to obtain a 10 and then pay the TDS amount and file the application forms, file the TDS returns under the regular 10 mechanism. From October 2026 onwards, a new schema has been defined by the government, which was announced in the Finance Act 2026. And by virtue of that, what would happen is that by just making the single tax payment challan on the portal, which is under the regular route, with that only all the compliance would be taken care of. So then that additional compliance and hardship of taking a new 10 number and then filing the TDS returns, that is something what will be done away with. So this is something very positive steps which is likely to kick in from 1st of October 2026. Let us go further, please. Okay, now another difficulty what we usually observe is that many times there are people who had proper nexus or relationship with India at one point of time. They decided to go and settle abroad. They are mostly doing business from a foreign country. Say example again UAE. Say Sahil, he went abroad to Dubai, and in a free zone or maybe in the mainland, he formed a company there, and most of the business operations he's handling from there only. Mainly he's into, say example, he's in import or export of business, or maybe in some service consultancy business, and he has a small office there. He has properly formed a company in UAE. He has a proper registration number. He has a bank account, everything properly in place. So that is technically a foreign company. We understand that in India, from your residency rules, you are taxed as an individual when you become a resident. But when it becomes when you look from a company's perspective, a domestic company is something which is always taxable. Foreign companies, prima facie, they are not taxable in India. But what we need to understand here is that residency rule is something which goes parallelly hand to hand from the basic residency rules per se, and the provisions what is typically called as POEM, place of effective management. Now, a company per se operated by and handled by and incorporated in Dubai, UAE is a foreign company. But if the company breaches the rule of POEM, and if it happens that the place of effective management is read out to be in India, in that case, though the company is a foreign company, registered company, though prima facie Sahil is a NRI, but that company can also be taxed here in India. This is a big time problem what sometimes is faced by a lot of clients when a few conditions are not taken care of. So POEM, the first part, section 6.3 we discuss. One important thing is that we also have a circular which is comparatively a breather circular of 2017, where it says that this POEM provisions would not set in unless and until you cross a turnover threshold limit of 50 crores. However, if you see a turnover limit of 50 crores from a global business perspective, this limit itself is a very small or a very low level limit. So any global transaction just crossing 50 crores is just a month of time, and in that case it can very much happen that this particular threshold is already triggered and the turnover of the company is more than 50. In this case, the POEM provisions would click in. Now, along with this, we would also see something like what is active business outside India. There is a test. This also we need to do to see whether the POEM is getting triggered in India or not. So there are 4 important criteria what ideally we would like to see. So we take an example. Can we go further? Okay. Or maybe come back, please. Hello. Can you come back, please? Move back.
Go back to the video.
Yeah, thank you so much. So we look at these 4 conditions first. So if Sahil has a company in UAE, ideally he would not have any assets in India. Further, he would not have employees in India. The payroll costs would also be outside India, and most of his passive incomes also will be outside India. So if there is anything in India and which is not something really major, say a small percentage of it, then it is absolutely fine. A foreign company may have an entity in India, but we take an example where Sahil has everything outside India. So his company assets, he has 2-3 employees which are also in UAE, Dubai only, and everything from last 8 to 10 years is outside India. But because Sahil has got family, friends, and other relations here in India, also a lot of clients he still has in India, and he is the director and the shareholder of that company. It could always happen that Sahil at times in a year, once or twice, makes a visit to India. And in that case, what can happen is that he does some strategic meetings with clients. He closes the deals. He decides what price with what client to be given, and based on that, those information, the contracts are signed. What happens is that he is becoming a strategic decision maker here in India. Second, what can happen is that if there are board meetings, if those board meetings are basically taken care of, or they are attended from here in India, or sometimes it could even happen to the extent that the board meeting could be outside India, but because he was here in India, he is doing a video conference from here in India, and there would be mails, correspondences, etc. So what in this case would happen is that effectively the the basic test of active business, whether outside India or not, that prima facie is being complied. But because the poem Sahil himself, the person who is the main managing director of the company, he is basically coming here and taking decisions from here in India. What would happen is that this business entity, which is a foreign entity, would also be treated as a poem having a place of economic presence here. And because of that, it would become a taxable entity in India. So this is a big time risk what business entities which are otherwise foreign entities, and prima facie you may feel that this is not taxable out in India anyways, but it could trigger here. Now, sometimes how would the department find out that this has happened? What happens is, from practical perspective, in the initial notices when the department sends, at that time they would only ask you to give you your passport details, your visa details, or compute how many number of days when you were in India, and what kind of business structure you have, and what kind of how your business mechanism works, your nature of business, who are the key managerial people here in India, or from the UA office and all. So on the basis of that, they would be doing some kind of a Reiki initially, based on which they will come across a conclusion that there is a possibility of this entity falling within the trap or triggering points of poem. And from that, then the additional analysis would start, calling for additional details, mails, the minutes of who was where, who attended the meeting from where, those details would be asked. And based on that, it is very likely that these things may be unearthed, and the department may again come to a conclusion, post certain requirements from the department and all. And basis to that, the poem may be concluded to be here in India. What would be the impact of this? Let us go to the next slide. So the impact of this is, we already discussed in general, that first, though it is a UAE company, taxable at 9% corporate tax right now in UAE, will also become a taxable entity here in India. Just think, for example, if this entity or this example is not pertaining to UAE, but this is, say, US, UK, or some any other jurisdiction, which is basically a high tax jurisdiction, say 30%, 40%, 50% rate. In that case, what happens? The amount of tax rate here, tax rate there goes for a toss. You would be required, once poem is decided, then you would also be required to file your ITR 6 for a company. But mostly you never thought of this probably, and you would have not filed ITR. So non-compliance on your side for non-filing of ITR. Transfer pricing provisions, maybe you have not looked into, you never thought of this coming up. That is something where you get more exposed. There is probability that there might be some kind of offshore benefits which you might lose on the basis of DTAA, etc. What we discussed earlier, Monica discussed, and the double taxation benefits also, like eventually the overall loss. So then the consequences and the cost can be very high, and you become basically a red flag entity in India. So that is something what we need to avoid, and that we need to plan properly. So at least from that perspective, what we need to do is properly do that kind of management a procedure where the person who is part of the management does not take any strategic business decisions when he is in India, or they does not attend any board meetings here in India, so that that benefit of or this question of their coming within the four corners of definition of poem itself is something what is ruled out. And this kind of this kind of uh, rights can be delegated maybe to some other person in the entity, in the organization, who is basically a resident outside India only, and that is a proper way of planning and managing things. I hope this point is clear. Let us go further, please.
So thank you, Mala. In the interest of time, actually we have to stop here. Okay, so with this, we have come to the conclusion of the session. And for this, I would like to give a vote of thanks. Thank you to all our presenters for sharing their valuable insights on the taxation NRI taxation part. Special thanks to Gitika for covering the residential status, to, headwise taxability, and to Monica for explaining the importance of DTAA, key treaty articles for NRIs, Article 13, 15, and 23. You explained it really well, and claiming treaty benefits as well. And special thanks to Zephyr Mala for sharing the practical cases, studies on the capital gains on the sale of property. You gave a very nice example when I moved to UAE. Yeah, so thank you for that. Together, the session has provided a practical overview, key insights, and the relevant NRI and cross-border on the wealth. Thank you once again to all the presenters and people who are working behind the camera, my IT team, my marketing team. We look forward to welcoming you again in the next edition of Knowledge Setu. So till we meet again, thank you. Thank you so much, everyone. Have a great day.
Thank
Bye-bye.
you. Thank you.
Thank you so much.
Thank you so much.